Right now, thousands of Social Security, SSI, and SSDI recipients across America are sitting on a tax time bomb, and most of them have no idea it's ticking. Here's what's actually happening. When Congress passed the Social Security Fairness Act and eliminated the windfall elimination provision and the government pension offset, over 3.1 million Americans received large retroactive lump sum payments in 2025, totaling a staggering $17 billion. Some of those payments top $2,000 or more in a single deposit. Sounds like great news, right? But here's the part nobody's talking about. Under current IRS rules, those retroactive payments are fully taxable in the year you receive them. That means if that money landed in your bank account last year, the IRS now expects you to report every dollar of it on your 2025 tax return, which is due right now before March ends. For many retirees, that one deposit quietly pushed them into a higher tax bracket, increased the portion of their Social Security that gets taxed, and could even trigger higher Medicare premiums going forward. And Congress is scrambling to fix it. But that fix has not been signed into law yet. So what do you do right now before the deadline hits? Stay with me because I'm breaking down exactly who this affects, what your options are, and what steps you need to take today. So let's go back to the beginning of all this because you need to understand what actually happened before you can understand why your tax return this year might look completely different from anything you've ever filed before. On January 5th, 2025, President Biden signed the Social Security Fairness Act into law. This was a massive piece of legislation that repealed two long-standing provisions that had quietly been reducing or completely eliminating Social Security benefits for millions of Americans for decades. Those two provisions were called the Windfall Elimination Provision, known as the WEP, and the Government Pension Offset, known as the GPO. Now, those names sound complicated and boring, but what they actually did was very simple and very unfair. They punished people who spent their careers working in public service jobs that didn't pay into Social Security. Jobs like teaching school, working as a firefighter, serving as a police officer, or working as a federal employee under the civil service retirement system. These men and women worked hard their entire lives. They earned a pension. And then when they went to collect their Social Security benefits, the government turned around and slashed what they were owed, sometimes cutting it in half, and in some cases eliminating it entirely. That was the law for over 40 years, and now finally that injustice has been corrected. The Social Security Administration began adjusting monthly benefit payments starting February 25th, 2025, for people whose benefits had been affected by the WEP and GPO. If a beneficiary was due additional benefits as a result of the act, they received a one-time payment deposited directly into the bank account SSA had on file, so millions of Americans, teachers, cops, firefighters, federal workers, suddenly saw money they hadn't expected dropping right into their bank accounts. And that sounds wonderful. That sounds like justice. And it is, but here's where the story takes a turn that almost nobody was prepared for. Because that money, the IRS wants a piece of it, and the deadline to deal with that is right now. The average retroactive payment under this law is estimated at around $6,710. On top of that, increased monthly benefit payments to those affected were expected to start in April 2025. So we're not talking about pocket change here. We're talking about thousands of dollars dropping into people's accounts completely out of the blue. And for many retirees, that was the most money they'd seen in a single deposit in years. Some people got $2,000. Some got $5,000. Some got $10,000 or more, depending on how long they had been underpaid and how severely those old WEP and GPO rules had cut into what they were owed. The SSA issued more than 3.1 million payments, totaling $17 billion, completing the process ahead of schedule. So this wasn't a small program. This affected millions of real American families. Now, here is the problem that Congress did not fully think through when they passed this law. Under current IRS rules, Social Security benefits, including retroactive payments, are taxable in the year they are received. So even though that lump sum payment was money you were owed going all the way back to January 2024, money that should have been paid to you gradually, month by month, over the course of more than a year, the IRS doesn't care when you earned it. All they care about is when it landed in your account. And since it landed in your account in 2025, it counts as 2025 income, every dollar of it. That's the rule. And that rule is creating a real financial crisis for people who were just trying to get what they were owed. A retiree who got a large catch-up payment in 2025 must include it as income on their 2025 federal tax return, being filed now during the 2026 tax season, even though the money reflects benefits earned over a much longer period. For some retirees, that one-time spike can push them into a higher federal income tax bracket, increase the share of Social Security subject to tax, or trigger higher Medicare premiums down the line, perhaps without any real change in their underlying financial situation. Think about that for a second. You didn't suddenly get richer, you didn't get a raise, you just finally got paid what the government had been withholding from you for years. But because of the way the tax code is written, your income on paper for 2025 looks much higher than it actually is, and the IRS is treating it exactly like you went out and earned a second job. The taxation of Social Security benefits remains unchanged after the law's passage. Up to 85% of the benefits may be federally taxable, depending on the taxpayer's combined income. For single filers, if combined income is between $25,000 and $34,000, up to 50% may be taxable. Above $34,000, up to 85% may be taxable. For married filers filing jointly, the thresholds are $32,000 for no tax, between $32,000 and $44,000 for up to 50%, and above $44,000 for up to 85%. And here's what makes this particularly rough for seniors who were right on the edge of those thresholds. If your normal income kept you just below the line where Social Security gets taxed, that one lump sum payment may have pushed you right over it. Not just for the lump sum, but for your regular monthly benefits too. So now a larger portion of everything you receive could be taxable, all because of a one-time payment that wasn't really extra money at all. And it doesn't stop there. A lump sum retroactive Social Security retirement payment can trigger changes in your modified adjusted gross income, or MAGI, leading to higher Medicare premiums or other changes to your healthcare coverage. Your MAGI determines eligibility for specific healthcare programs, including Medicare Part B premiums. IRMA, the income-related monthly adjustment amount, is a Medicare Part B premium surcharge based on your MAGI. So what this means in plain English is that receiving that retroactive payment might actually cause your Medicare premiums to go up next year, because the government looks at your income from 2 years prior to set your premium level. If your income spiked in 2025 because of this lump sum, you could be looking at higher Medicare costs in 2027, even though your real everyday income hasn't changed at all. That is the kind of cascading unintended consequence that the people writing this law simply didn't anticipate, and it's hitting real people right now. So what can you actually do about it today? Because this is the part that matters most, and this is the part that most people are missing entirely. There is actually a legal way to reduce the tax hit from that lump sum, and it's called the lump sum election. Beneficiaries who received benefits that were taxable in 2025, including a lump sum benefit payment for an earlier year, can reduce the taxable amount with the lump sum election, according to the IRS. This is an option that exists right now under current law that you can use on your 2025 tax return. This option allows them to recalculate the taxable portion of the benefits using the income from the previous year, 2024 in this case, instead of including everything in 2025. To make this choice, the taxpayer checks the corresponding box on line 6C of Form 1040 or Form 1040 SR. The IRS provides worksheets in Publication 915 to calculate whether this method reduces the taxable amount. The choice only applies if it results in lower taxation. Now, that might sound complicated, and to be honest, for a lot of people, it is going to require the help of a tax professional or a certified public accountant. But the key point is that this option exists, and you should not file your 2025 taxes without at least looking into it. A good tax advisor will run the numbers both ways, the standard way and using the lump sum election, and figure out which method results in a lower tax bill for you. And if the lump sum election doesn't help in your particular situation, then you simply don't use it. But if it does help, it could save you hundreds or even thousands of dollars on this year's return. Using the lump sum election does not require a taxpayer to adjust an earlier return, nor does it require filing an amended return. You're not going back and redoing old taxes. You're simply choosing how to calculate this year's liability in a way that is most favorable to you. Now let's talk about something else that's happening in Washington right now, because there's a bill moving through Congress specifically designed to fix this exact problem, and you need to know about it even though it has not yet become law. The No Tax on Restored Benefits Act, introduced in February by Republican Representative Lance Gooden, would exclude certain retroactive Social Security payments from taxable income. Supporters say the bill would prevent retirees from being penalized for receiving years of delayed benefits all at once. The bill has bipartisan support, meaning both Republicans and Democrats are behind it, which is genuinely rare in today's political environment. And the reason it has bipartisan support is simple. Both sides of the aisle recognize that what happened here was an accident. Democratic Representative Chellie Pingree of Maine, who co-sponsored the bill, said the Social Security Fairness Act was never intended to saddle widows, low-income seniors, and dedicated public servants with an unexpected tax bill. But here's the important thing you need to understand about that bill right now, today. As of February 4th, 2026, the No Tax on Restored Benefits Act was referred to the House Committee on Ways and Means, where it currently sits pending review. It has not passed. It has not been signed into law. It is not yet in effect. And that means if you are waiting for Congress to save you before you file your taxes, you could be making a very expensive mistake. Even if lawmakers act quickly, the IRS would need to issue guidance clarifying how the new exclusion would be implemented. In the meantime, advisors say clients should prepare based on current law rather than potential legislative changes. So the professional advice across the board from accountants and financial planners all over the country is to file based on what the law actually is right now, not what it might become. If you were receiving a lump sum payment in 2025 for increased benefits dating back to 2024, it's wise to review your current tax situation. You may want to update your withholding preferences using IRS Form W-4V to avoid an unexpected tax bill next April. Form W-4V is a simple, voluntary withholding request form that you submit directly to the Social Security Administration. It allows the SSA to automatically withhold a percentage of your monthly benefit and send it to the IRS on your behalf. This way, you're not getting hit with a large tax bill all at once at the end of the year. Instead, the taxes are being paid gradually in small amounts every single month. If you've never filled out a W-4V, now is the time to look into it, especially since your monthly benefits may now be higher than they were before the Fairness Act took effect. There's also something else worth considering if you are currently receiving SSI, which stands for Supplemental Security Income. Supplemental Security Income payments are not taxed. If SSI is the only payment you receive from the Social Security Administration, you will not receive a benefit statement, and this tax situation does not apply to you. So, if your only income from Social Security is SSI, you can breathe a little easier on this particular issue. The tax complications we've been talking about apply specifically to Social Security retirement benefits, spousal benefits, and survivor benefits, the ones that showed up on your SSA 1099 form in January. If you received SSI and nothing else, that income is not federally taxable and you are not in the group affected by this lump sum tax situation. But if you did receive a retroactive payment and you also receive SSDI, which is Social Security Disability Insurance, then you absolutely need to look at your SSA 1099 carefully because disability benefits can be taxable depending on your total income level. The same thresholds that apply to retirement benefits apply to disability benefits as well, and that lump sum payment landing in your 2025 income could have consequences for your SSDI taxation the same way it does for retirees. So do not assume you are in the clear just because you are on disability. Pull out that SSA 1099, look at the total amount reported, and if you are not sure how to handle it, get professional help before March ends. It is also worth noting that most states, including Ohio, do not tax Social Security benefits. However, 8 states currently do, so be sure to understand how your state treats retirement income. This is another area where a lot of people get caught off guard. You might manage the federal tax situation perfectly and still end up owing money to your state, depending on where you live. If you are in one of those states that taxes Social Security benefits, the retroactive payment you received could also create a state tax liability on top of your federal one. Check with your state's Department of Revenue or a local tax professional to find out exactly what the rules are where you live. And finally, let's talk about what you should be doing with your bank account and your SSA records right now. For retirees, the immediate practical step is to ensure their bank account information is up to date with the Social Security Administration. The lump sum payments are being issued directly into bank accounts on file, and the SSA has asked retirees to wait until April before inquiring about delays. But verifying account information now is a simple way to help the process go smoothly. If you moved, if you switched banks, if you opened a new checking account at any point in the last couple of years, go to ssa.gov right now and make sure the information they have is current. The last thing you want is to have your payment bounce back because it went to a closed account and then be stuck trying to sort it out with an agency that is still processing millions of cases. The bottom line here is this: the Social Security Fairness Act was a genuinely good thing for millions of hardworking Americans who had been shorted on benefits they earned. But the way it was implemented created real unintended tax consequences that nobody warned people about. You deserve to know about the lump sum election option on your Form 1040. You deserve to know about the bill in Congress trying to fix this. You deserve to know about the W-4V form so this doesn't blindside you again next year. And most importantly, you deserve to know that the deadline is right now before March ends and tax season closes in. Don't let this catch you sleeping. Get your SSA 1099, sit down with a tax professional if you can, and make sure that every dollar Congress gave back to you actually stays in your pocket where it belongs.